Welcome back, investors. Jake here. Quick life update. I've made it to the house that I'm leasing in Las Vegas. However, my household goods won't be delivered until Friday, so I'm doing the best I can to make this video for you today. And this last week, because I've been driving so much, I haven't been able to pay attention to the markets during the day. In my Schwab accounts, we'll just go ahead and say I started the year with $60,000. And my account was up by a significant amount, up to 66,000 just a week ago. However, the markets have been reeling this last week, and my Schwab account is now down to 56,000. The reason why is because this account is 80% leveraged on call contracts. So if the S&P goes down just a little bit, the returns in my account will be more dramatized. And half of this loss, really the last week, half of this loss is this debit spread that I opened on SPY back in November. That's what we're going to cover in this video today. If you're not familiar with the debit spread that I opened on November 18th in my Schwab accounts, you can watch these two videos. The first one was a put debit spread that I actually opened on October 26th. And then it expired worthless. I lost all of the premium I paid for the contracts. So I then bet the other way, and I bought a call side debit spread for significantly more money. In effect, I more than doubled down to try and get back what I lost. This is probably all terrible trading advice, and I just perfectly mistimed it on both directions. So let's quick recap what I did the last 4 months and just how I could not have timed it any worse, guys. What's that famous saying that the market fools most people most of the time? Well, I got fooled, because if we go back to October 22nd, it was on this day that I opened a put side debit spread saying if the market goes down, if the S&P can just go down a little bit, I can make a decent amount of money. I think my max gain was about $3,000 if SPY just went down by like 3%. And I opened up the put side debit spread on October 26th actually. So it was this day. The market then just went straight up, straight up for about 3 weeks. And I was betting the market was going to go down because the Fed was meeting and the Fed was going to announce tapering. I thought there would be a negative reaction to the Fed saying we're not going to be buying U.S. Treasuries as much. Additionally, guys, I was noticing a pattern in the market that around the third Friday of every month, this is the monthly options contracts when they all expire, the market freezes up. Liquidity kind of drops. And the reason why I think this happens, not every month, but many months this happens, is because large institutions that are going to exercise on other people or be exercised on, they have to be prepared to buy 100 shares. If you're exercising a call contract, you're paying the strike price per 100 shares per contract. And if you're on the put side and you're going to be putting 100 shares in another person's accounts, you have to buy it that Friday that the option contracts expire, either before market close or shortly after market close, in order to exchange all the shares for the strike price that the seller of the put is going to pay you. So look at this pattern, guys. We have August 19th, the market freezed up for a couple days. We have July 19th, July 20th, the market froze up. We have June 18th, June 21st, the market froze up. Let's see here, May 19th, the market froze up. So I said that this was going to happen potentially in November, and it didn't. So here we are in January, guys, and guess what is happening once again? It's the third Friday of the month. Additionally, January, the third Friday of the month, has the most options contracts traded in the entire year. So anybody who wants to buy options contracts for 2023 or 2024, they're buying and selling them in January basically as a marker. So look at what is happening here in anticipation. It's currently the 19th. Friday will be the 21st. So for everybody saying what's going on, why is the market selling off, why is it freezing up? I think it's because it's the third Friday of the month coming up. All of these options contracts are going to be expiring. And I think volatility come next Monday will drop. We're going to kick off earnings season for all of the big tech stocks. I think they're all going to have a fantastic fourth quarter. The S&P is probably going to rebound. But that's not going to help me with my debit spread that I opened on, let's see here, November 18th. So on November 18th, I opened a call side debit spread saying, SPY is going to go to 480 at least. And it didn't, guys. It pulled back on news of Omicron. Everybody was freaking out about this new variant. The market then kind of got over it because it's not as deadly, though more infectious. And then the Fed, because of 7% inflation, announced they're going to speed up tapering. They're going to reduce their bond purchasing. And we're looking at more rate hikes. Analysts and banks are now pricing in 4, 5, or even 6 rate hikes this year to get inflation under control. So maybe you could argue that triggered this sell-off the previous week, but this week I think it's because it's the third Friday of the month and all of these options contracts are going to be traded. This definitely affects the performance and the volatility in the market. And if your account is positive so far this year, please tell me how you did it, because everything is down. And I'm not just talking about SPACs, IPOs, or companies that don't make a profit. It's the profitable companies that are all down too. Look at Microsoft, market cap 2.3 trillion. From its high, it's down over 10%. Google, market cap 1.81 trillion. Let's say from a month ago, it's down 7.6%. Amazon, market cap 1.61. From its high, it's down over 14%. Nvidia, market cap 643 billion. From its high, it's down 22%. Tesla, market cap is still over $1 trillion. From its high a month ago, we'll say it's down 15%. JP Morgan, market cap 443 billion. I guess they missed on earnings because they're down over 10% basically in 2 days. United Health Group, from its high, market cap 437 billion. It's down over 8%. Home Depot, market cap 381. This is down over 12%. Adobe, market cap 243 billion, down over 24%. Netflix, market cap 227 billion. It's down over 25%. So when you look at the performance of SPY from when it peaked, it's only down 4.5%. Everybody complains that the index fund is top heavy. It's overweight on the mega cap tech stocks. But if all of the mega cap, large cap stocks are down double digits, how is SPY only down 4.5? So obviously there's been a rotation into energy companies and utilities and reopening stocks, basically companies you think will benefit if the pandemic is over. But I personally don't think this is going to last, guys. And I think that people are going to come back to amazing companies like Google and Amazon and Adobe. These sell-offs, I think, are temporary. So I'm looking in my Schwab account to rotate some of my positions into some of these companies because I think these are very profitable, very predictable, stable, long-term, good investments. So let's go into my Schwab accounts, and I'm just going to recap for the people not familiar with debit spreads what exactly I did and how much I lost, because it's not good. So here we are with the 10 calls that I bought with a strike of 470. So if SPY goes above 470, I start making extrinsic value. I start making money on this contract. And these are the 10 calls that I sold against it. You can't sell calls unless you own the stock or own calls at a lower strike. This is basically covering your short. If you want to sell naked calls, you got to get approved for the highest level of trading with your broker. It's extremely risky. Nobody recommends it. So when you buy calls with a lower strike and then sell calls at a higher strike against them, this is a covered position. Your broker allows it. It serves several purposes. The main one being it makes these contracts basically more affordable. So the 10 contracts that I bought, I paid $10,326 for. And the 10 calls that I sold against them, I got back a credit of $5,153. When you do this, you cap how much you can make because as soon as SPY goes above 480, however much I'm gaining on these contracts, I'm losing basically in equal amounts by expiration on these. So you're just trying to capture price movements in a very narrow range and leveraging your money with duplicate contracts to dramatize your returns basically. So on the strike of 480, this is only in the money if it gets above 480. It's definitely not going to do that. So I paid 5,153. Oh no, I got a credit. But to get out of this position, you have to buy it back if you want to close it. You want to buy to close. So I've made basically the full premium. The value of these 10 contracts is currently $15. To buy to close them and get out of this position on the short side, I have to pay 15 bucks, which I think I will do today. Obviously, there's like a 65-cent commission with Schwab, so that's going to cost me $6.50, but it's probably still worth it. Now, the calls that I bought are not going to get above 470. Just being real with you guys, SPY is at 457. Is this going to get above 470 to make me any money at all in 2 days? It's currently Wednesday. It's not going to happen. So these are also going to expire worthless. I paid $10,326 for them. They're currently only worth, if I sell to close them, they're currently only worth $145. So I've lost the difference between these two amounts. I've lost a total of $5,130. So when we look at my Schwab account performance, being down 10 grand from my high, about 4 grand since the beginning of the year, even though I'm doing pretty well. I'm up 68% on my Apple contracts. I'm up 145% on my Berkshire Hathaway contracts. I'm up 45% on General Dynamics. I'm up 21% on HCA. Even though I'm doing so well on my individual stock picks, I YOLO'd on this debit spread and lost it all. I lost all 5 grand. So yeah, this was a stinger. This was a teachable moment. On my channel, guys, I have full transparency with everything I do in my Schwab account. I practice what I preach. And when I lose it all doing the highest risk form of options trading, debit spreads, I want to show you guys. I want to show you that it's not easy money. I bet the market went down and was wrong. I went the other way and was wrong again. So I'm 0 for 2 on debit spreads in my Schwab account this year. Okay guys, the next week or two is going to be crazy for this account because we've got earnings for all these companies. Apple reports on January 27th, along with HCA. On January 25th, Texas Instruments and Capital One reports. On January 26th, General Dynamics reports. And these quarterly earning reports are the wild cards, guys. When you trade on fundamentals, you're using past performance from previous earning statements. And when you trade on technicals, those can always be broken by a bad quarter or a good quarter. So I don't know what's going to happen with these companies. I don't really view myself as an expert on the inner workings of this company. I have no insider knowledge. I just have their past performance and a belief that these are all stable, profitable companies that will not give me too much unexpected news on the downside. So in the next couple days, couple weeks, I am going to take profits potentially on Apple and Berkshire. I'll show you how I'll do that. And then I'm going to sell or get out of maybe General Dynamics in order to get into potentially Google or Amazon. I'm looking to take a leveraged position in one of these companies because I think both Google and Amazon have been trading sideways for a very long time, and they're going to have a good 2022. Okay guys, that wraps it up for this video. If you want to support me and my channel, the easiest way is to give this video a thumbs up. If you have any comments or questions, let me know down below. I love hearing from you guys. Till the next video, take care.